you have to be willing to make no money in that first year or two. Like you're going to like process a couple dollars, you're charging a transaction fee, you're way upside down on those unit
You mean
economics. And
on a
like,
per user basis, you're not making much money?
yeah,
And
on like or no, on a per company basis. Like if you're processing payments for a YC startup that does
yeah.
100K in MRR, like you're making like a few $100s a month at best, you know?
Yeah,
And
and you're
so
probably
it's
in
sort
the
of
hole for like $50 just onboarding them and doing all the KYC.
exactly.
Hi everyone, welcome to Founders in Arms podcast with me, Imad Akhund, co-founder and CEO of Mercury.
And I'm Raj Suri, co-founder of Lima and Tribe. And today we have longtime friend, Bill Clerico. Welcome.
Good to be here, guys. Thanks for having me.
Bill, we wanted to get you on for a long time. So, Bill, you were founder and CEO of WePay, sold to JPMorgan Chase, and now you're a founding managing partner of Convective Capital, focused on wildfire. Did I get that right?
That's right. Yeah. And I think, Raj, we first met in like 2008 in Boston at an open coffee event when we were both starting our respective companies, I think prior to us ever raising any money. So it's been a fun, 20-year journey knowing you and when watching you build.
Yeah. Starting to feel like veterans in the space, right? Like,
yeah.
But
you guys are old.
Yeah,
exactly.
I was at Cal Academy with my son this past weekend, and someone asked me if I was his grandfather, which was kind of a mortifying moment.
I think the slightly gray beard thing is like doing that. You should shave. It'll make you look younger.
I gotta mix something up. That was a real moment of self-reflection as I turned 40 in 2 weeks.
Oh, you're not even 40 yet. Okay, well,
I know.
I was just going to say, how much did you sell WePay for? I feel like it was significant, but I can't remember.
It was about $400 million when you calculated enterprise value and some earnouts and performance and stuff like that. About $400 million.
You were like OG fintech. When you started WePay, did you feel like, oh, I'm I'm one of the first doing fintech, or did you feel like, oh, I'm late to the party and I can't believe it took me so long?
Fintech wasn't even like a word. Like the category was like financial technology, and
it was payments, right? It was called payments. Yeah,
payments.
It was called payments.
I hate that phrase, payments. I was like, what does that even mean, payments?
Exactly. And the feedback we got from most VCs when we were starting was like, no one has ever made money in payments except for PayPal, and that was such an anomaly because of the team. And it's so regulated. It's run by like an oligopoly. It's hard to break into, and as like two 23-year-old founders, basically they just were like, why are you building in this space? It's really hard. You should just go build like a photo sharing app or something like that. And so we got like a ton of no's, and it was very much like against the grain to build in payment space. But that is actually an insight for me. That was like, when most VCs say a space is bad, then your ears should perk up, because there may be something really big there. And they obviously missed Square, Stripe, Mercury, Robinhood, the next generation of iconic companies. And fintech's been one of the best spaces in technology over the last 15 years.
Well, sometimes they're right? As in sometimes the space is actually bad. So like, how do you tell as an entrepreneur that like actually the space is actually bad and you should probably not do anything in it, versus like VCs are wrong? Or I guess like maybe you just don't know.
I think they were both right and wrong about payments. Like, they were right. It is highly regulated. It is run by an oligopoly. Like, all those things were true. I think what they were wrong about was that if you could figure out ways to solve for that, you could actually build a very iconic business with like little competition in these great markets. And so I think that there's a real nuance there. Like, you can't just like bury your head in the sand and say, I'm just going to go build in this space anyway and like screw the haters. I think you really have to understand the complexities and the challenges. But if you can come up with a solution to those complexities and challenges that no one else can, that can be a really interesting space. And, that was sort of an insight that ultimately led me into Convective and, investing in a space that I think is not quite so obvious for similar reasons.
The two other things that help with fintech is the market is freaking huge. So if you do figure it out, like the prize at the end is huge. And then the kind of the mega trend of like cloud and mobile and the internet was like kind of fueling it forward, right? Like things like Stripe and WePay and all these things need to exist in the world of like digital apps and all these things. So I think those are like the other two things. Like, maybe it probably was wrong to do fintech in like 1999, and PayPal was the only one that figured it out. But by 2009 or whatever, it was like the time had come where these technologies were kind of pushing it forward.
Yeah. Yeah, I do think the underlying market is enormous. Like I remember I had a stat in my pitch deck, and it was like there's, some insane number of checks written every year. I think it was like $4 trillion of paper checks or something that are used for person to person transfers. And it was, this was in 2008. And so it was, that like the underlying market was really big. It just was hard to sort of break into.
Yeah. Wait, so you were saying this led to something in Convective? I interrupted you.
Oh yeah. So I think at Convective, which I could talk more about, but there's sort of this, I think, bias in the VC world, or at least historically, against companies that sell to government, companies that sell to utilities, companies that sell to insurance companies. They're sort of seen as these like large, bureaucratic, sleepy institutions that, there's been no great tech companies built that sell to these companies. I think that's still pretty commonly held, sort of wisdom amongst investors. But I think similar to fintech in 2008, the underlying markets are enormous. There's trillions of dollars of capital expense, trillions of dollars of reinsurance capital and property that's protected. The government obviously is the largest spender in the world on anything. And so if you can figure out how to crack those markets, they're enormous. But it requires sort of a different way of thinking in terms of how you go to market, different expectations around speed, a different playbook than selling B2B SaaS. And so kind of our bet at Convective is that those are actually very attractive markets that are sort of on the cusp of being cracked by technology. And if you build a specialized investor that can go back startups going after that space, the prize could be really huge. And so, our sort of stated strategies around wildfire as a starting place, and I'll sort of talk about why, but the much bigger opportunity is sort of this, what we would think of as like physical risk management or resilience. Like there's just sort of a rising volatility in the world for a number of reasons. And if you can help, physical asset owners have stability, I think that is, a multi-trillion-dollar market over the next 15 or 20 years as volatility continues to increase.
Very exciting thesis. I mean, very important thesis. I'm a big believer in what you're doing there at Convective, Bill. I'd love to talk more about that. But I also am really excited. I want founders to hear your story of WePay, because WePay, you talked about how hard it was. I remember how hard it was because I was there with you before while you were starting it. I believe this was like 2008, the depths of the great financial crisis, right? You decide to start a payments company in that time. Tell us about your journey, because you and I started back in Boston. It was really a wasteland, right, compared to what it is today. I mean, the whole ecosystem was a wasteland. So maybe talk about...
There was like 5 entrepreneurs in Boston. It was like you, me, Jason Jacobs, who's starting Runkeeper, and Dharmesh and Brian Halligan, who were starting
That's
HubSpot.
right.
And
Yep.
that was like literally it. It was just sort of a funny space. So we all kind of knew each other. So I guess our journey, I was, so I went to Boston College. I studied computer science, graduated and worked as an investment banker, doing tech M&A. Did that for 1 year. One of the things about working in investment banking is like you get to see like your finance peers, and you're like, oh, okay, what does an MD in an investment bank look like? And then you get to work with a bunch of technology clients who are like founders building these amazing companies, selling them, taking them public, and like, what does a founder of a tech company look like? And you get to actually work pretty closely with both of them. And so it's just like kind of this very obvious fork in the road for me, where it was like, do I want to be that person or do I want to be that person? And it was just really clear to me that I did not want to go be an MD at a investment bank, and I wanted to go build companies. It just looked like they were having so much fun. And so I got my bonus at the end of my first year. I quit the next day, and I called up my freshman year roommate, Rich Aberman, from college. He was living in Florida at the time. Packed up, moved to my house, lived on my couch, and we just started like hacking on ideas. And one of the ideas that we were most excited about was can you make it easy to collect money from friends? So Rich happened to be like planning his brother's bachelor party where we were like renting a house in Florida. And we're chasing everyone down. We got the spreadsheet to track expenses. And, we were sort of looking at that and saying, like, we can make this a lot easier. And right around the same time, the iPhone App Store was opening up and the Facebook platform was opening up. So it was kind of like this convergence of like social, mobile, and, this problem. And that was kind of the original idea for WePay. And so, we, like any good investment banker, the first thing I did was I made a pitch deck and I tried to show it to every venture capitalist in Boston. And they all like said no to me in various ways. I think partially because it was 2008 and it was just literally like people thought the world was about to come to an end. I quit on August 2nd and like Lehman Brothers imploded on like August 14th. So it was just like right in the middle of all this. And I think partially because we were like two 23-year-olds building in this payments category that everyone was really bearish on. And so, we sort of limped along for about 7 or 8 months until ultimately we applied to like Combinator. And, Paul Graham interviewed us in his garage. They funded us on their front lawn. And then we packed up my Camry and we drove to California the next day. So it was sort of a quick turnaround. And that was sort of an inflection point for us. And we kind of got the Silicon Valley playbook and were able to raise money and, a bunch of other stuff happened.
You got your amazing $15,000 from YC.
It was $18,000 plus a $600 travel reimbursement, and we felt that was a lot of money to us at the time. We stretched it quite far, actually.
And you pivoted, right, Bill? I mean, that wasn't the idea you landed on. I mean, what I was really impressed with it was like how adaptable you were throughout the journey. Because I was kind of following you in many cases. Like, I came to Silicon Valley a year after, right? And I was looking at you how you were doing, compared to, Silicon Valley versus Boston. So that was a big, inspiration for me also to move. And so I came in YC 2010. You came in, I think you were 2009, right?
2009, yep. Yeah. Yeah, so we got into YC. We, went through the process. We stopped doing our pitch deck. We built a product. We got users. Our first users were like fraternities at San Jose State that would use us to like collect dues. It was sort of working, but not like really working. But it was enough to raise money. So we like raised money at demo day. We raised $1.7 million at a $3 million pre-money valuation, which was the highest valuation in our YC batch. I was quite proud of it. But
that's huge for 2009. Yeah.
That was like that shows you the times. From there, we went on and raised a Series A. We raised like $7.5 million after that. And it was kind of enough to like keep the machine going, but it was just like, we didn't really have great unit economics. People used it occasionally to like collect money for a one-time event, but it wasn't this like recurring use case. It was really hard to get, sort of this repeat recurring usage that was going to build a big business. We were also charging fees. People didn't want to pay fees to do person-to-person transfers. And so we actually, as like an experiment, we had one of our summer interns build an API that would allow like third parties to build on top of us. And by chance, one of our very first user of the API were the two founders of GoFundMe, and they were building a crowdfunding site to collect, donations. Yeah. And they were frustrated with PayPal, which had like a really bad developer experience. And they built on us. And, it was like kind of a small little side project, and it was great. We were still running our business. And then all of a sudden it just started to grow. It was sort of like they were really growing. Other sort of crowdfunding sites all started building on top of us, because what we had for our own customers built this really easy sign up process where you could start collecting money right away and then sort of provide your tax ID and a bunch of the other sort of high friction steps after you were kind of already collecting money.
Just to step back a second, Bill, how did you figure out the Rails stuff? Like, did you go to a bank partner? And like, back then there wasn't that many kind of people out there to go integrate with. Like, how did you, as like a couple of kids, go figure that out?
Yeah, it was kind of like the Wild West at the time. There was no like fintech, like banks didn't work with tech companies. And so we had like a merchant account that we were using to just sort of process these third-party payments. And the merchant account provider at one point kind of realized what we were doing and shut off the merchant account, but didn't tell us. And so we were like, and their API was still returning these like positive responses, and we weren't charging cards. And so we actually woke up one day, we were like, oh my God, we have not been actually like charging people's cards for the last like 2 weeks. We have to go like do a sketch. So it was very sort of clunky and scrappy, and we were always trying to find the right financial partners that
So
would sort
initially,
of
you were kind of breaking the rules of this merchant account
yeah.
service, right? Like the terms and conditions, at least.
We would argue that we were technically in compliance, but I don't think that they
Of
loved
course.
this idea of sort of processing for third parties. Um, and then it was sort of as we got bigger, we started to be more commercially attractive to folks, and then they actually started to kind of engage with us at the right levels, and eventually we found like a partner that would sort of set us up properly, and we had a more stable thing. But in the beginning, it was very much like a trying to twist the existing capabilities of these like very stodgy systems to kind of suit our needs, and it was very
This
like
is like
Wild West.
for a long time, this was kind of the chicken and egg in fintech, that like you needed like enough scale that you could like get a payments infrastructure partner or bank or whatever, but then you can't get that scale without getting them. Like even when Mercury in 2017 we raised whatever $6 million, it was still hard to get like that first bank sponsor. I took to like 60. I think that's got a lot easier as there are a bunch of people in that are willing to do these deals, but it's still really hard. It's actually one of the hard initial kind of nuts to crack.
I think now there's at least some success stories where it's like, okay, if you're the early partner to a Mercury, like that is an amazing business at scale. And so now you've got folks that are willing to take that risk. Whereas at the time, it was just kind of like all downside for the bank. And they were like, we don't want to, help. What if something bad happens on these platforms? But we were able to kind of like twist things and make it work. And then we saw our API just start to grow. And we kind of were in this tough spot where it was like 60% of our revenue and volume was like the P2P product, and 40% was the API, but the API was growing like 8 times faster. And that was sort of the inflection point where we said, okay, like we got to like shut off this business and just focus over here. And so we did that, I think in hindsight, far too slowly, but eventually did that. Incredibly painful process, because we had all these people that came to work at a consumer company and had consumer skills, and now we were like an infrastructure company, and we had like massive outages and availability issues. 60 something percent of our company attrited that year, a combination of them quitting
Oh
or
my
us having to
gosh.
move them out. It was just
Yeah.
like, yeah, it was extremely painful. It was really 2014 when this was like the heart of this pivot. And we eventually got through it, but it was that was a tough year.
I mean, the story isn't done yet, right? Like, how did you get the sale to JPMorgan, like a massive company?
Yeah. So we continued to grow after that. So we got to this pivot. We had a good business. It was sort of, we were doubling year over year for a long time. And we got to profitability, which was great. So we got to about, we were about 100 million in sort of gross revenue, call it, kind of 40 to 50 million in annual net revenue. And we were break even. But when we were looking at the space, I think because we were too slow to make that pivot, and we also had like a really amazing competitor in Stripe that had, captured, that had been earlier to this sort of developer platform strategy. And I think also accrued huge capital and talent advantages of like, unicorn founders in the Collisons. And so we were competing with this juggernaut that was sort of increasingly, clear that they were the leader in this space. And, we had our good business. It was, growing nicely and break even, but, we were never going to supplant them as the market leader. And so, we thought,
let me just dig in on that. I mean, like, looking at it back now, 10 years later or whatever, right? Like, I mean, Stripe is still a juggernaut, and but there is a clear number 2, Adyen, right? And like, we know now, like, there is space for multiple players in this market, right? Like, do you see, like, maybe that thesis might have been flawed? Like, you're never going to compete with Stripe. I mean, if you kept competing with Stripe, there would have. I mean, the market was big enough, right?
For sure. I think we could have just like kept grinding and kept like growing the business, 60 to 100% a year, break even, turning the crank, building enterprise value. And we probably ultimately would have had a bigger outcome than we did. But that just wasn't the business I wanted to build. Like we had originally started this consumer business. We wanted to build something that was like high growth and iconic. And I think we were end up building like a good business, but it wasn't going to be sort of a category leader. And so, yeah, I think as Rich and I thought about like the opportunity cost of our time and our passion and what we wanted to do, we just said, okay, this has been like a great run and we'll continue running it, but it's not necessarily where we want to spend the next decade of our life. And we started sort of chatting with folks about various types of partnerships, and we got to know the folks at JPMorgan. And they had a real strategic hole in their offering where they also needed to compete in this sort of new developer driven ecosystem. And we were able to put together a deal that made sense. And so that was sort of the ultimate decision to sell the company, and we sold it in 2017.
Not to push this point too much, Will, but like, is there anything that you look back on and you're like, hey, if we had done this thing differently, maybe there was a 10x bigger outcome to be had, and like you could have grown faster? I mean, you said maybe if you'd gone all in on developers quicker, but is there any other strategy or like some thought that you're like, oh yeah, there was another path there and we could have taken that?
I think the biggest thing that we could have done would just have been to make the pivot much faster and more aggressively. Like it was sort of like a little we were like really pushing on the
how many months did it take before you kind of
it was really like it was probably like, it's embarrassing to say, but it's probably like 2.5 years, from like,
oh wow, okay, so you were sitting on this idea for a long time.
Yeah, we were like sort of we built the API initially as an initial project, then we were running both businesses in parallel.
So why didn't you like the API idea? Is it just because you really wanted to build this consumer app?
I really wanted to build a consumer app. I also sort of, we were also seeing, Stripe, even at that point, was starting to really take off. And there was like other companies in that category. And so, it wasn't clear to me that it was like sort of that it wasn't going to be really competitive, And so I think that like, I think I also underestimated just how powerful the developer is as a decision maker in payments. Like I was kind of like, okay, just because you have a better API, does that actually going to drive this like massive business decision where a company's going to spend many millions of dollars? And I think in hindsight, the answer is yes, that actually does drive a lot of it, because if you are sort of infrastructure in the early stages of a company, you stay with it over time. But that point wasn't obvious to me at the time.
I think there's so many unintuitive things about Stripe, which is partly why like they're so big and there's not that much competition. Like in 2008 and 9, no one would think the developer is the one choosing the payments thing. And then B, that you could get in so early that it's at the start of the company and that company will scale with the infrastructure that they set up for like these payments from the start. And then C, which I think is like actually the craziest one, is that this seems like such a commodity business, right? You're taking like a few bits from every payment. It feels like once you hit a certain scale, you will like go to another provider that gives you a slightly better price. But like, why isn't it a commodity business? Well, I actually still don't quite understand why.
I don't understand that either, honestly.
I also think the fourth point is that like you have to be willing to make no money in that first year or two. Like you're going to like process a couple dollars, you're charging a transaction fee, you're way upside down on those unit economics.
You mean on a per user basis, you're not making much money?
Yeah, on a per company basis. Like if you're processing payments for a YC startup that does $100K in MRR, like you're making like a few $100s a month at best, And
so you're probably in the hole for like $50 just onboarding them and doing all the KYC and risk ops and stuff.
So it's sort of like that thing is an aggregate. I think what makes it not a commodity is a couple things. One is once you're sort of payments in particular, you're so entrenched in the way these companies work. Like it's not just like some back office vendor that can be swapped out. Like you're integrated into the onboarding flow, into the checkout flow. Like these are like, it's the like, you're really in the critical life systems of these companies. And so like swapping them out is like super risky. It's also a lot of work. Like you have to like now redo all this stuff. And
also Stripe did this thing where they would store the customer's card information, right, on your behalf. So like that was like a bit of a data moat that they built.
Yeah, you can start to entrench that stuff. You're like over time as you have scale, like your authorization rates go up, your costs go down. So there's like, I think reasons to that sort of becomes defensible. But it's like, if you're running a company and you look at like, okay, I'm going to go swap out my payment provider, or I'm going to go build the next 3 features, which are going to help me grow revenue, you're almost always going to get much bigger.
Yeah, one point, just a lesson for founders. Like, the way you decided that you weren't interested in running this business further, and you started setting up the company for a successful sale. I think that's a really important skill that obviously they don't teach you in Y Combinator, right? So, like, so you were really smart about this, right? You started building these partnerships. with folks, but you were thinking about the sale, right? You were thinking, you're constructing these partnerships in the beginning. How did you construct the partnerships in a way that led you to this outcome?
Yeah. So we took it pretty seriously. We took, my co-founder Rich was running product, and we said, Rich, you're no longer going to run product. You're going to go out and go build these partnerships, because this is like one of the most important things that you do. It's like a real founder skill set. And so the idea was, we were basically pitching a white label version of WePay, where we would go to the large banks and other processors and say, you need a great developer platform with easy onboarding. Like, we can give that to you as a service. And, let's go have this conversation about how strategic that might be for your business, how big of a business opportunity it could be, how we could work together. And so it led to these great conversations, and it took probably about a year from like the first conversation to ultimately selling the company. But the nice thing about that is it was sort of a like low risk way to engage all the product teams and business owners and get them like super excited about what they could do if they had this product internally. And then, it sort of made sense for them to think about, is this actually something we want to partner with, or is this something we want to just own? And that was a very like natural segue of that conversation. I remember, our counterpart at JPMorgan just saying, we're sitting in my office, and he's like, we were negotiating about some partnership terms, and we were like driving a very hard bargain. And he just said like, well, what if we just buy you guys? And so that was sort of when the conversation started to change.
That is truly brilliant. And I talk to so many founders who have the wrong concept of like selling a company. They're like, they think you go through like you hire an investment banker and you go through like the sale process. But actually what you want to do is exactly what you did, which is you want to incept the idea of like buying your company into their brains without saying that, right? Explicitly.
Yeah, we hired an investment bank, and they produced zero alternative buyers. It was really like it was, because they ping the corp dev people, and the corp dev people have no power. And so you really need like an executive in the business to say like, we need this capability, and go to bat for it.
Also like the white label approach, because you're kind of like making them imagine what it's like if they just own this thing. You're like, oh, imagine if it's a JPMorgan Pay.
Yeah, we did mock-ups. We basically helped them write the whole business case themselves.
What was the timeline from like you saying, Rich, this is your full-time job, to like, you getting the term sheet?
It was probably about, I don't know, 12 to 18 months, something like that.
So that's insane. I think that's actually the hardest part of acquisitions. Like, people like founders are used to like fundraising, and like you're like, oh wow, like a 3-month fundraise is like a long, hard fundraise. Like 12 to 18 months, like, most founders can't think that far ahead, because they're like, we're going to be dead in 12 to 18 months.
Yeah. But we were the first acquisition that JPMorgan did since they bought like Bear Stearns and Lehman Brothers. So like a big part of it was like making the case, but then them also figuring out like how the heck they were going to do this. And so we would have like 25 or 30 people come to our office from JPMorgan for like a 3-day onsite. And then we like wouldn't hear from them for like 2 months, and then they'd like come back. And so it was a very like, it was definitely a long process.
How did you keep the morale at the company while you were going through this? I feel like that's always a tricky part of acquisitions.
We didn't read anyone in on it, and it was very much like we were also like, we didn't know if it was going to lead to an acquisition. So we had a bona fide strategy to try to like leverage these third-party partners as a way to grow. And so, it was
so internally you were selling it as like a white label WePay, like this is what we're building.
Exactly. And then once we sort of shifted gears, we had like a very small group that sort of would talk about the acquisition side of it. But then once kind of this word gets out, you've got to go quickly. I think it's almost impossible to like take a whole company through an acquisition process. It's just like, there's too much ups and downs and backs and forths and stuff like that.
Yeah, agreed.
Really well done. I think it's it's a great case study for other founders. Like we don't have enough of these like founder case studies. We have all these Harvard Business School stuff, but it's nothing like founder case studies like this are really good lessons, I think.
Yeah, I mean, I think there's certainly things we could have done differently, and like probably if we just ran the business for another year, it probably would have been twice as valuable. So like you can. I don't think it was, I don't give myself like flawless execution marks, but I think we did, I think we did pretty well considering what we wanted to achieve.
You never know. It sounds like you were quite top heavy as well. Like potentially you could have lost one of those merchants to Stripe or something, and that could have hurt enterprise value. So I think it's like hard to second guess these things.
I think that's actually a really important point as well, which is like timing for founders is really important. Like even like what deciding like when to sell shares and stuff, like which I've had to make the decision on, several times, right, for Lyft and stuff. And like the timing makes a huge difference, on like on these things. And like your outcomes dramatically change if you're like wait 6 months or if you don't wait 6 months, right? So there's a lot again, something they
I think
don't
there's
teach you.
also,
Yeah.
I mean, from a founder perspective, I think if you've decided to sell, like the difference for Bill, I mean, I'm sure he would have preferred $800 million exit versus a $400 million exit. Like,
Yeah.
probably doesn't change your life that much. The funny thing is, as an investor, it does matter quite a bit. Like the extra 2x can be like the difference between a fund returner or like, half the fund, right? Like it actually makes a difference. I had this like funny realization. I had a company I invested in that like they sold for a couple of hundred million, and they called me up and they're like really excited. They're like, "Hey man, we sold for this much. We're gonna like return 10x your money." And I'm like, "Okay, I love this for you." Like, this is what I'm thinking. I didn't say that. I'm like, "I love this for you guys," but like, 10x is like, sure, you like didn't really pay off that fund, and it's fine. Like, I'm happy for them, and obviously it's better than failing. But I would much prefer they went for 20x or 30x or 40x, right? Like that. That's like the math that the investor goes through. But yeah, from a founder perspective, I think once you've decided like selling is the right option, like optimizing like the last bit of valuation like doesn't always make sense.
Yeah, I think if I were to really like do it again and I wanted to really go for it, I would have like reconfigured my job in a way where it gave me like where I was like excited to come to work. Like I think by the end I was kind of like felt like I was carrying everything on my back, had my fingers in every hole in the dam, and was just sort of like, and that really just tired me out. I was like ready to be done. Whereas
You
I
mean
think
at WePay?
at WePay, yeah, I think like if
What would you have done differently? Like, what do you mean you would have like
yeah,
been excited to
I
come?
think I would have probably hired some different people that could have actually shouldered those burdens. And I think I would have pushed more of the problems to the team. Like, I think I sort of felt like my job was to like shoulder the problems and protect them from like how hard our business was. And like, I think in hindsight, I should have stepped out of the way and let actually the team shoulder that stuff. And if they couldn't shoulder it, then they weren't the right people. And then I probably would have spent more of my time on like new products or spending time with customers or like the things that I thought that gave me like energy and joy. And I think if I had done that, I probably could have ran that business for longer and been happier doing it. But I was just super burned out from the way I was operating it. And so, that I think is a learning too for founders. Like if you really want to go the distance, like you have to also engineer your company in a way that makes you happy. Otherwise it's a ticking time clock.
Amazing. That's great advice. I went through the same sort of burnout too. So like but I did learn how to like shift the problems to my team, and like that's why one thing I say is like being a CEO actually isn't that lonely if you know how to do it right. So like if you do it right, like your team is there with you every step of the way. And like we talked about this concept before of like every executive is like a mini co-founder, carrying burdens for you, and they love that too. It's a win-win. Everyone wins.
I had 1 year at Mercury. I don't remember which year it was, maybe 2020 or something, where I'd spend the whole year, I think 22 actually, where I'd spend the whole year just like focusing on hiring because like we just started hiring execs and that can be very time consuming. At the end of the year, I was like, I hate this job. And then I really did this thing where, I mean, obviously like you do have to do the thing, like you can't not be hiring execs, but I realized actually it only takes like 1 day of doing like fun things like working on product, talking to the team, etc., to like rekindle my enjoyment. And then the other 4 days I'm willing to do the slop of like doing like continuous like hiring interviews or whatever it takes. But yeah, it is worth being thoughtful. Like, what is the balance? And yeah, I don't think you can avoid the grind though. Like, you can't just be like, hey, I'm only gonna do the thing that like I have fun doing. I think as a CEO, you just have to do. There's just some things that like you just have to kind of do. But yeah, there is like a balance to it.
Everyone's got to take out the trash, right? But I think you have to have the mix of things that like give you energy and to offset the grind, and I think like I was just sort of like I'm going to give this 210%, everything I got, and mostly on the grind side. And you just sort of like that. I was kind of like I was ready to be done. It didn't matter if you gave me double the money a year later. Like I was ready to go do something new.
I also think VCs could do a better job of like making sure their founders are like, actually happy at their work. I mean, to your point about like, if it was a double the outcome, like your VCs actually have more to gain from that. But
Totally.
I've rarely seen any VCs actually asking like, are you enjoying your work? Like it doesn't happen, right? They're like, what's the growth rate? What's the growth rate? What's the growth rate? What's the growth rate? Right? So it's just like, this almost never happens. I think that people ask you like, founders talk to other founders about this a lot. VCs almost never talk to founders about this.
Yeah. And arguably, it's one of the most direct things they can do to juice returns, is
Exactly.
to keep a founder energized and in the seat for longer.
I mean, do you think as a founder, you'd be like honest to your VC? If they're like, you have a good time, you'd be like, fuck yeah, let's go. You're not going to be like, oh man, I'm feeling depressed. Or maybe like, I think slightly more mature founders would be like willing to be a little more vulnerable, but by that point they're probably like figured it out anyway. But I don't think as like in my previous companies I would have been like very open about like.
It depends on the
not
relationship
enjoying
they
it.
build. If they build a good like trusting a human to human relationship, then I think you would, right? If it's more of like just a professional relationship, maybe not.
I think there's probably also an element of like most investors that just haven't been in that seat. So they're approaching it from the financial angle, like they're not seeing it from like the human angle as much.
Yeah.
So you said that like, hey, entrepreneurs can do a really good job selling to government and utility and like all these things. Like, have you developed a playbook where you feel like you can help founders that you invest in and sell to, I don't know, local government or whatever it is? And if you have developed that playbook, like what does it look like?
Yeah, I think so. I think similar to fintech, like these companies were hard to build until now. Like it was kind of, I would say 10 years ago, like, yeah, it's just hard to sell to utilities or insurance companies or government. But there's a number of things happening kind of right now that make these companies, I think, buildable for the first time. The first is that like these institutions are like, under a huge crisis. So like, PG&E, for example, our utility here in Northern California, started a wildfire, the campfire, and went bankrupt. Lost like 70 billion of market cap because of a spark on a transmission line. And they're Berkshire Hathaway is having these issues with utilities that they own. Lahaina Electric, their stock traded down, Hawaiian Electric was traded down 70% after Lahaina. So like these are like enormous financial costs for these companies that they need an answer to, and the answer is not just like we're gonna like trim a couple more trees around the lines or replace a couple of more poles. Like they actually do need to embrace technology now for the first time. And they're like willing to spend anything to like save themselves from this sort of risk. And so I think that like the sort of seriousness of the crisis has like cracked that market open now, for the first time. And then you also layer in, they're dealing with like surge in demand, in power demand from AI and EVs, the fluctuation of renewables, there's just sort of, permitting reform that allows them to kind of build things for the first time. And so like, it feels very much like an industry in sort of crisis transition. And like in that, I think there's a huge opportunity for startups to build solutions. Kind of feels a little bit to me like fintech in 2008 after the GFC. And so, our playbook there is like, go build relationships with the people in those, business units that actually buy this kind of stuff. Bring them together. We host this conference called the Red Sky Summit. This year it'll be about 600 people. It's, a bunch of like utility executives, insurance executives, government agency leaders, fire chiefs, founders, investors. It's like this group of people does not get together anywhere except for like this conference. And be able to kind of, create these sort of connections and relationships and kind of make technology cool to the incumbents. That's been pretty effective. It does take special founders. It does take, the ability as an investor to understand, like, is this pilot at this utility actually going to turn into a real contract? But, we've seen, pilots go from a $50,000 pilot to a $300,000 a year pilot to a $7 million a year pilot to a $200 million contract. So it's sort of like, if you can get over the hump, the budgets and the level of spending on infrastructure is just absolutely enormous, but you have to be able to underwrite it at this early stage, which I think is hard to do.
How long to get that pilot, like the first pilot, to get like, investors interested as well?
I think the pilots are actually relatively easy to get. You lots of utilities do pilots. You can get one in a few months. But the real question is like, there's a huge sort of like valley of death after the pilot to like program of record. And that's where I think you actually need to be able to talk to the people in the utility and call the VP of wildfire risk and say like, hey, you put a couple of these sensors or cameras on a pole, like, how's the pilot going? Are you going to actually go buy a lot more of this? Or what would you need to see to buy more of it? And unless you know that person, it's just really hard to like to sort of tell the difference. And you're really talking about like a small number of really big contracts. So it really kind of matters to be able to understand that. And I just think there's very few investors that have that type of relationship or expertise.
It's really interesting strategy. You're building like this, like almost industry specific, like, relationship set and also expertise, right? And what you're talking about resonates with me a lot because we sold into the restaurant chains, and like that's exactly what it takes to get these deals done is like these back channels, right? And those relationships, and also there's a big trust factor, right? Because these utilities, they're betting on a startup, a company that maybe not have done it before. It's a big risk for them. So having someone like you underwrite the whole thing and they'll say like, hey, we'll support this company, or this company's going to do it, that also helps them make the decision to move forward.
Absolutely. I think it's very hard if you're a utility executive, like you see hundreds of startup pitches, like it's if you're not a venture capitalist, like to be able to tell who's legit and actually going to make something, it's hard. So like I think we get to be a bit of a trusted advisor to them and say, our investment is a little bit of a mark of approval, and we can help create like forums for them to help figure that out.
So you're becoming this like utility whisperer, like
yeah, a bit, and the like the sort of not so secret like long-term plan, we started in wildfire because I think it's really acute and a big crisis, but I just think the world is becoming more volatile. There's you have climate change that's increasing storms and floods and heat and drought and affecting crops. You've got like rising nationalism, you've got tariffs, you've got pandemics. Like there's I think the world feels a lot less stable today than it did 10 years ago, and my bet is 10 years from now it's going to be even less stable and more volatile. And so, I think about, who gets affected by that. It's governments, it's utilities, it's insurance companies, it's people that own physical assets. And so, I look at us ultimately as an investor in kind of risk management for the physical world. Like all these people need to manage that risk, and they need new solutions. And I think that there's like, trillions and trillions of dollars of like value that's at risk. And if you can help them protect it, there'll be some really large companies built doing that. And so that's kind of our end goal, is to kind of be this investor in what we call resilience.
That's super cool. The point you mentioned, do you actually have an insurance company? Like I saw like a tweet from you or something like suggest that you're doing. Is that something you're doing?
Yeah, we're investors in a company called Stand, and we helped incubate it as well. And so Stand, in California, it's really hard to get homeowners insurance in high fire risk areas. The insurance companies have very little ability to understand risk at like a structure level. Like they'll look at risk in sort of a zip code, but like you put two houses side by side, in many wildfires, one of those houses burns, one of those houses doesn't. And like, why is that? A lot of times it's because of vegetation around the house, or it's building materials around the house, or it's the ability for a firefighter or a fire engine to get in there and protect that structure. It could be a sprinkler system. Like there's a number of things you can do to actually affect the underlying risk of that house. And so what Stan does is we offer homeowners insurance bundled with like risk mitigation requirements and services. And so, we'll actually look at the actual structure and some of the attributes of the structure and underwrite the risk that way, and give homeowners discounts for mitigation, or underwrite structures that no one else will, because we can understand the risk at a more detailed level. We build these, computational fluid dynamic models to simulate fire moving through. And so that's the business. Yeah.
So you're taking advantage of all these insurance companies like exiting California. You're like, no, we can do this better.
Yeah. I mean, there's many parts of California where no one will write insurance at any price. And so and that's just irrational. It's kind of like there is a market clearing price for risk everywhere, and so
I thought one of the issues was that California does not let insurance companies pick the price. Like I thought there was price controls.
Yeah, there's two segments of the insurance market. There's the admitted market, which has price controls for the regulators. And yes, that market is like deeply dysfunctional because we've artificially capped price increases relative to the risk. But then, if you can't get insurance in the admitted market, there's the non-admitted market, which doesn't have those price caps, and that's where Stand participates. In that market, there's still not a lot of options, but you actually can offer sort of these risk, policies that are priced in line with the risk.
This is maybe getting in the nuances of it at the last bit, but what does that mean? Admitted market, like these are like
the
big
admitted
insurance
market are
companies,
sort of, they're like overseen by the California regulator, and they have to file a rate plan. So they'll say like, hey, we're going to charge 0.5% of the insured value to insure homes.
But why doesn't everyone just leave the admitted market and go in the non-admitted market? Like, what's the benefit of staying in there?
Yeah, the benefit for a consumer. So you're required as a consumer. We're going to really get into it now. You're required as a consumer to participate in the admitted market unless you get turned down. So like you have to go get three quotes in the admitted market, get rejected before you can go to the non-admitted market. And then for the insurer, being in the admitted market allows you to sell policies in the vast majority of the state that are like safe and, pretty straightforward. And so it's really only like these specialty insurers in these like high risk areas that participate in the non-admitted market, but, like us. And so
that's a super interesting nuance. Yeah. And I think it'll be even more important to you as you go. If volatility keeps increasing, it seems like everyone's going to be unadmitted soon.
Yeah, that is our bet. That I basically like either the admitted market will have to rationalize price and then we'll move into the admitted market, or everyone's just going to move into the non-admitted market. And so, I think either way, if we can understand the risk of a structure burning better than anyone else, like we should, be able to be a really large insurance carrier.
All right, Bill. I think we could probably go on for another hour here, but we have to wrap. This was super fun. We should have started on time.
Thanks for having me, guys.
But,
it's great.
Good chatting, Bill. I hadn't heard some of the kind of WePay's selling stories, so it was kind of fun to get into that. But yeah, we should have you on again in the future.
Yeah, I would love to. And I love what you guys. I love the format of this, where you're kind of having real conversations with people. So that's great.
It's great, and yeah, we would love to dive into. I mean, I never would have imagined 2008 that you'd be, selling insurance in California, right? Figuring out holes in the market.
Long ways from bachelor parties in Boston.
Yeah, exactly. Yeah.
Thanks everyone for listening. Please leave us a review on whatever channel you're listening on. Makes a big difference to the algorithm and to the success of the show. And see you all next week.